Welcome to this month's Trade Floor Update. Today I'm joined by Adam Bowe, one of the portfolio managers in our Sydney office. Welcome, Adam. My first question today is around inflation. Last week was announced that Australia's Consumer Price Index, or inflation rate, fell by 1.9% in the June quarter and was negative 0.3% over 12 months. Given we're also seeing significant fiscal and monetary policy easing, what are PIMCO's expectations for inflation in the short and long term, and how are we positioning portfolios?
Well, Marcus, in the very near term, I think that big negative inflation print for Q2 will be largely reversed, as it was driven in large part by policy responses with respect to COVID-19, in particular the provision of free childcare. So if you make a big percentage of the consumption basket free for a quarter, it exerts a large negative drag on overall inflation. And given the government plans to unwind that particular fiscal support in the near term, I think we'll see a similarly large payback within the next quarter's inflation print. But more importantly, looking through the noise of the quarterly prints, our baseline expectation for inflation remains pretty subdued, in the near term at least. For this calendar year, headline inflation will probably be close to flat, maybe modestly positive, and next year somewhere between 1% and 2%. Over the longer term, it should move back towards the central bank target band, which in Australia is 2 to 3%. And the RBA has been very explicit in reaffirming that objective and committing to retaining the current easy policy settings or even easing them further until they're comfortable and confident their inflation's moving back towards their target band. And we've seen unprecedented fiscal response as well here and overseas. So monetary and fiscal policymakers are certainly all in and trying to get inflation back towards their objectives. Importantly for our portfolios though, inflation expectations priced into bond markets are even more subdued than our baseline expectations. So with the near-term low inflation prints and very low inflation expectations priced into bond markets, it's quite a cheap time to buy inflation-protected bonds into our portfolios. So even in our baseline of low and anchored interest rates and subdued inflation, these bonds should outperform, with the added benefit of protecting portfolios if we're wrong and growth, inflation and interest rates surprise on the upside.
Thanks, Adam. Another topic I regularly receive questions on is how investors can generate income for their portfolios when interest rates are at historically low levels. Throughout 2020, we've seen many companies reduce or cancel dividend payments to shareholders. This is underscored last week by the regulator, APRA, telling banks they must cap dividends at 50% of earnings. Now, what are the implications for bondholders when dividends are cut, and how else can investors generate income in a low rates world?
I think these types of environments always highlight the structural advantages that bonds have in providing income, particularly during times like this when investors really look to rely on income the most. Dilutive equity raisings, reduced dividend payments, they're all negative for equity investors, but obviously they're very positive for bond investors as they lower leverage within a company and increase cash available to make interest payments. Historically, I think Australian investors have used a really barbelled approach to generating income in their portfolios, with stable term deposits on one hand, but then very volatile high dividend stocks on the other. Now, term deposits likely offering negative real rates of return on a forward-looking basis, and the recent experience of declining dividends, I think investors again have the opportunity to really explore the attractive range of alternatives in the global bond market in between those two extremes of term deposits and equities. I always try and emphasize that the global bond market is a big place. It dwarfs the size of the global equity market. So there are plenty of attractive options and opportunities to help Australian investors solve their income puzzle.
Thanks, Adam. Now, my final question is around portfolio construction. PIMCO is expecting the economic recovery to be U-shaped and gradual, with speed bumps along the way. How does PIMCO ensure we're building resilient portfolios that can handle potential shocks?
Yes, we are expecting a long U-shaped recovery as our baseline, but I think we have to have a really healthy dose of humility and recognise that the high level of uncertainty and a range of different scenarios that could play out from here. I mean, even with all the policy support that's in place, some areas of the economy may be permanently impaired, and the risk of capital impairment makes this an environment to tread very carefully in and keep a defensive mindset when constructing portfolios. I always think it's helpful to step back and start by remembering the dual role that bonds play in broader portfolios. First, to generate income, and second, to provide the diversification benefits to the riskier parts of our portfolio. And although many fixed income sectors have retraced a significant amount of the spread widening we saw in March, we're still seeing a number of attractive opportunities that can deliver income and the potential long-term price appreciation. But active management remains critical. A couple of sectors that stand out in this respect are global financials. It's a sector we've liked for a while. And also more recently, bonds issued by Australian regulated utilities. These are less exposed to the downside scenario of a second wave of virus infections. And for the diversification benefits of core bonds, the long end of the Australian Commonwealth bond market looks pretty attractive right now. Importantly, it's getting the balance right between the attractive income-generating assets on the one hand and the diversification benefits of longer duration government bonds on the other that we spend a lot of time on. And getting that balance right helps us build portfolios that generate healthy levels of income while being resilient to a range of different economic and financial market scenarios.
Well, thank you very much for your insights, Adam, and thank you everyone for listening in today. I hope you're staying safe and well, and if you have any additional questions, please feel free to reach out to your PIMCO account manager.